The Bucket Plan On Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.
Hey everyone, thanks for joining us. We're excited for this webinar of this series around what's your client's net worth, uncover 3 new opportunities with the Asset Sheet Questionnaire. So we went into some more of the stories and different ways that you can utilize this tool and benefits of it in the podcast. Definitely recommend you to listen to that if you haven't already. But this webinar, we're going to go into a little bit more of the techniques and show you the visuals of how we're using it, and also the tax efficient funnel, which is an awesome complement to use to explain how the Asset Sheet Questionnaire kind of lays out the different types of tax status on your different accounts.
So with the Asset Sheet Questionnaire, some of the main benefits it's going to really help is it's going to help your clients understand their own net worth. It's going to help them get organized and get a snapshot of what their net worth is so that you can measure the progress each and every year. It's going to streamline the process of capturing beneficiary designations and asset titling. We shared some key stories on that in the podcast. This is a game changer and a differentiator for you. This will earn you clients right in and of itself and is an amazing benefit that I recommend go back, listen to the podcast to hear about how you can add that to your business. It's going to help identify estimated tax liabilities and solutions to diffuse them. So understanding a liability that your clients may not have ever known they even have. And so a number of different core benefits of the Asset Sheet Questionnaire, but it's also going to help you organize the assets to prepare for your plan design. So as Jason and I both, as financial planners, we leverage bucket plan. We believe in bucket planning. And what the Asset Sheet Questionnaire does is it helps us categorize and organize the assets to prepare for that design.
Yeah, it compartmentalizes the different types, right? So we have pre-tax money, we have post-tax money, we have tax-favored money. So it really does a good job of subtotaling those. So when we go to design the plan, we can kind of see really where we're at and move those assets around. If you're following a bucketing philosophy, especially, it makes that plan design so much easier to do that.
It's going to help you capture those beneficiary designations and asset titling information, as we mentioned earlier. So again, this is just going one layer deep in documentation. In a fact finder, you might not be asking these questions. You might be just more high level. But in the Asset Sheet Questionnaire, this is where we are checking up on all these things.
And it can create the need for life insurance too. We'll cover that in the liability section. We went a little deeper on it with the podcast, but we'll hit on it here too, so you can kind of see that supporting visual.
Yeah, what we want to start off with is showing this tax efficient funnel concept. And so, as you're diving into the accounts and really documenting things and going through and helping build your client's net worth statement or asset sheet using this Asset Sheet Questionnaire, it's a great opportunity to take a step back and deliver some education on not only what they have, but what types of accounts they have it in and how that works. And so this tax efficient funnel is a very simple image to help clients understand the different types of money and how they can leverage the order of money to maximize cash flow, not only today, but into the future. And if we think about this, and we know this as financial professionals, there's really 3 funnels of money. There's your pre-tax money, where you could make contributions into these accounts with pre-tax dollars. So you get a deduction today to save in these types of accounts like 401ks or IRAs. Maybe you have a pension available. But down at the bottom of the funnel, you can see when money comes out, guess what? You got to pay the piper. Distributions from these accounts are going to be taxed at ordinary income rates. Now, over on the far right-hand side, we have tax-advantaged accounts, kind of the opposite of pre-tax accounts. Here, your money, your contributions go in with after-tax dollars in most cases. Now, there's one little exception, the HSA account. As long as you're not in California or New Jersey, they don't recognize HSAs. But in all other states, you can put pre-tax money into the HSA. But for all these other accounts, Roth plans, FSAs, 529s, cash value life insurance, generally it's after tax dollars going in, tax deferred money as it grows. And when you take money out, as long as you follow some rules, distributions are tax free. Then in the middle funnel, this is where you're kind of dinged on both sides of it. You're taxed as money goes in, so contributions are made with after tax dollars. You invested in things like brokerage accounts, real estate, and potentially bank accounts. And the growth on that money is going to be taxable. So we all know if you put money into a CD at the bank is going to send you a little love letter every year known as a 1099 that makes you report that tax and pay tax on that gain. If you invest in a brokerage account, a non-qualified post-tax brokerage account, you defer taxation until what? Until you sell. Once you sell, you're taxed on the growth of that asset. Same with real estate. Now there's a couple small exceptions for your primary home. But again, helping clients understand these tax efficient funnels and not only how much money they have in each, but what they mean, and planning opportunities that exist. You see, because we explain to clients that there's this pendulum that kind of sits between pre-tax and tax advantaged. And that pendulum is going to help us determine which way it's going to be most efficient for you to add money into these accounts, but also take money out of these accounts. So if you're in the accumulation phase of the money cycle, maybe in some years, based on tax policy and you, it's going to make sense to go and save in pre-tax accounts. If you're in retirement, based on the current tax policy and your personal situation, income, Social Security, pensions, etc., it might make sense to supplement your income out of those pre-tax accounts. And so what we look at is measuring your individual tax bracket. And that's going to really determine, hey, do we, if we're saving, take deductions today and pay the piper down the road? Or do we pay tax today and save it in a Roth account or a cash value life insurance account, knowing we're going to have tax-free income later on? And I always tell my prospects and clients when I'm explaining this, that pendulum always is changing. I mean, we're approaching a presidential election. Every candidate is proposing new tax reform. And based on what that reform looks like and based on your individual situation, maybe that pendulum is going to swing to the left. And you want to save your money in pre-tax accounts, take advantage of that deduction. Or if you're in retirement, maybe we want to supplement your income from your retirement accounts. But in other times, that pendulum might swing to the right. And we want to save in tax-advantaged accounts, or we might want to take out of tax-advantaged accounts. But every single year, we're going to manage your tax situation and see which way this pendulum is swinging, and I swing it back and forth.
It's so powerful because both in accumulation, you can make smart decisions, and then in distribution, you can make smart decisions. But the key is to have both types of money. You need to have the pre-tax, you need to have the tax advantage to be able to have that flexibility to be able to draw from both.
And my personal preference, I stay agnostic to it. I say, you know what, there's certain people out there that'll say the sky is falling and taxes are going to be insane in the future and you should only do tax advantage.
Yeah.
There's other camps that say you should only do pre-tax and defer everything.
And I tell you, I've always gone, I've converted everything to Roth. I've been all about getting in tax advantage. But, as an evolution of my own learning as an advisor and a tax planner, I'm actually starting to accumulate some money in pre-tax because in a lot of it, and I'm going to give thanks to my buddy Tommy Martin at Vestia, he really brought a lot of this thought leadership of kind of this concept of the pendulum swinging and the flexibility one year to the next, because my thinking before that was forget about it. I want to buy all the government out of all my money, go all tax advantage. Now with this concept, it actually does make sense to leverage your bets. And it really was just kind of like this idea of that pendulum swinging based on the current administration and tax laws, and whether you're in the accumulation or in the distribution phase.
Well, it's funny, and tax diversification is so important. And an advisor asked me a couple years ago, they were in that same camp, said everything needs to go into Roth and cash value life insurance and be tax free. And my comment back to them was, as long as I believe the government is going to give a standard deduction, I want to have some money in pre-tax, right? Because the government's always going to give me a certain amount of income I can take out tax-free. Yeah. And most people think the standard deduction is not going to go away. I mean, that would be massive tax reform.
No doubt.
And so, again, there's a balance. There's a pendulum that's always going to swing back and forth. And this is a great educational concept for your clients as you're starting to categorize their money into these different types of accounts.
So we use that tax efficient funnel visual and concept to explain as we're filling out this asset sheet questionnaire to educate the client on the different types of tax status. So let's just I'll do a quick review. I'll fly through this of just like what this asset sheet questionnaire is. So let's say, we got a husband and wife. And so first section is post-tax money. This is money in like bank and credit unions. So you can see it's like company name and the owner and type and due date. If you have CDs, so many times people with annuities and CDs and bonds that are maturing, they're not capturing that data, put it into the CRM and follow up. Payable on death or transfer on death designations if your state allows for probate avoidance. If you allow that, then you can put beneficiary designations, per STRPs per capita. There's going to be no fees on bank or credit unions typically, but then the values, and you can see a subtotal. So most of these columns are pretty similar in these different ones. This is the first post-tax type of money. The next post-tax type of money is going to be...
Oh, you know what, Jason, real quick, I want to just jump back real quick because we talked about this in the podcast and we don't have to spend a ton of time here, but beneficiary designations. And so like in this case on a post-tax account, a bank account, not a lot of people realize they can go to the bank and get a POD or a TOD designation on that and actually have a beneficiary. And then when you have a beneficiary, naming per STRPs and per capita. And we verbally went through this on the podcast, but I think it's also good to show a visual of the difference between per STRPs and per capita. Absolutely. And I think this is a great whiteboard concept. So I'll walk up to the whiteboard with a prospect and I'll say, here's you, right? The grandparents, husband and wife, the kind of patriarch and matriarch of the family. And you have two kids. You have two sons, and one of your sons has grandchildren, right? And so that one son has two grandchildren. Now, what I simply ask them is, God forbid, if your son, who's the parent, predeceased you, would you want the inheritance to 100?
Is that a sack of potatoes in the hand? Because it looks like 3 grandchildren.
I don't know. That might be the new one. Maybe they're expecting one. That one's on the way. He hasn't dropped it yet. So what I ask is, would you want 100% of the inheritance to go to the surviving child and disinherit the 2 grandchildren down here? Or would you want this one's 50% of the share to go to the grandchildren? Right. And most of the time, they want it to go to the grandchildren, right? They don't want to disinherit their grandchild. But that's exactly what per capita has the ability to do if they haven't gone through and updated and checked all their beneficiaries. So if they have per capita as the beneficiary designation, that one who predeceases gets pretty much their grandchildren or their children disinherited. 100% of the money would go to the surviving child. Right. And so what we can do is we can simply fix this by setting up per STRPs. And that's why it's so important on this asset sheet questionnaire to go through each account with your client and document that.
Yep, no doubt about it.
All right, take us back through post-tax.
Yep, and so post-tax, so the first section, the $95,500 top of the screen, that was the subtotal money in the bank, credit unions, that type of money. Then you have post-tax investments, right? And so similar, like this is where we're capturing, you can see the column cost basis, right? The fourth one over from the right. So that's an additional one. Now here's where fees become more relevant. And sometimes you have surrender charges if, post-tax money is in annuities, for example. So you can see though, you list that account and then you have subtotal 131 and the total of post-tax money is 226,500. You add the 95 plus the 131. Now, next section. So we got the total for a post-tax. Now we're going to pre-tax. Now we're listing out all those type of accounts, gathering all the relevant data. The only difference is here, husband and wife listed separately, but then we still come to a grand total of what the pre-tax money is. But as we know, we can't mix, IRA, 401k money together with the husband and wife. Then you have tax favored assets. So this is Roth IRA, 401k, 403b, HSAs, 529s, etc. These are other types of tax favored assets. We're going to list out all those into this third section. Fourth section, life insurance. This is just high level. What do they have? What's the premium, beneficiaries, death benefit, cash value, if there is any. So you can see we have those totals. Then there's real estate and or business interests. And so we're going to list those things out, how things are titled, cost basis, value, bennies, etc. Debt. Typically, like in this case, you got a mortgage, interest rate, monthly payment, how many years remaining. We're going to list those things out. And then here's the current estimated tax liabilities. Now, we talk more in detail on this on the podcast if you want to hear more about this. But basically, in collaboration with Ed Slott, this is where this idea came from, is listing out their tax liability, income tax liability, if they would draw out their pre-tax money, their IRA, 401k liquidation, etc. Or if they did a full Roth conversion, for example, what would the tax liability be? So what you want to do in this situation, to keep it really simple, is let's say they have a $500,000 IRA. Ask them the question, if you were to convert that entire IRA to a Roth, or let's say you cash the entire thing in because you wanted to buy a vacation home in Arizona, what amount do you think you would own percentage-wise? How much would you owe in taxes? Let them tell you. Whatever that percentage is, that's what you list here under current estimated tax liabilities. And so that's how you come to that number. But it's pretty powerful because it sets the stage for especially people who are proud that they don't have debt or they want to buy the government out of that tax-infested IRA money that they're in a partnership with the federal government on. It opens the door to start talking about IRA or insuring the IRA with life insurance, or doing some Roth conversions with bracket bumping. Really opens up some of those different approaches that you can explore with the client, start planting the seeds on by talking about estimated tax liabilities.
And then what you have the ability to do on the back of the Asset Sheet Questionnaire is just summarize everything, subtotal them all up onto a one-page document. If you have a paraplanner or you're doing the planning yourself, it just gives you a nice visual of everything that they have to start designing their plan. Post-tax, bank accounts, investments, pre-tax money, tax-favored, cash value life insurance. This is really their investable assets. So it's not including their debt on here. It's not including their real estate. And so it just gives you that one nice snapshot to consolidate everything all together for that prospect or client as you go to build their plan. Here's an example with that case study we just went through. You can see when we subtotal, it gives us a nice snapshot. 226 in post-tax, 563 of pre-tax, 56,000 tax favored, 26,000 in cash value life insurance for a grand total of 871,500. If you, as Jason mentioned earlier, you have the ability to, you can produce a finalized asset sheet that summarizes all of this. It's like a net worth statement that you can update each and every year. If you are with a FINRA firm and they don't allow you to produce a finalized asset sheet, you can use software or aggregation systems like eMoney. I know I personally use eMoney and create an asset sheet based on all the accounts being aggregated in there. But it's really nice to be able to see everything in one snapshot for your prospects and clients.
So the bucket plan, as Dave mentioned before, we also created a white paper on this. So you have the podcast available. You also have the white paper that's available, going through the opportunities of how to use this asset sheet questionnaire and the benefits of it.
There's also, as Jason mentioned, go to the podcast store, whether it's if you're Google or Android or Apple, it's on all the major podcast shops out there. search for the Bucket Plan on Demand. You'll get to hear a lot more insight into how to utilize this tool, stories of opportunities and planning strategies that might be able to go back and you can help your clients with, your prospects, to create more opportunities, to help bring clarity to their personal financial situation and win more opportunities for business. We appreciate you jumping on the webinar with us this month. And as always, we look forward to seeing you next month on the Bucket Plan on Demand. The Bucket Plan on Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.